One Battery Plaza, 9 Cola. Some attendees are participating via WebEx. Today is May 25th, 2023. It is 10:26 a.m. Mr. Dunn, would you please start the roll call?
Certainly, Madam Chair. Good morning, all. For Mayor Adams,
Brian Berge, representing Mayor Eric Adams, present.
for Controller Lander,
Allison Hirsch, representing Controller Brad Lander.
John Dorset, alternate for Controller Brad Land.
Commissioner Nybart, Finance.
Sheila Ray for Finance Commissioner.
Okay, for the UFA, Mr. Andrew Ansbro,
Andrew Ansbro, present.
Robert Eustace,
Present.
Edward Brown,
Present.
Eric Bischoff,
Present, good morning.
and is John Young on?
John Young is present.
Okay. For the UFOA, Chris Jensen.
Here.
William Guilfoyle.
Here.
James Brosey.
Here.
And for Commissioner Kavanaugh,
Krista,
we have a quorum.
thank you. We will start with the public agenda. I turn it over to the Controller's Office.
Thanks. So I believe our first item of the day is a update from Steve Meyer. Yeah. Yeah, I didn't know.
Yeah, thanks, John. So we just want to give you an update on the strategic asset allocation process that we've been going through. So we've been working on this, obviously in close concert with the various consultants. We're making very good progress. I want to ask Ed Berman actually kind of take us through a slide deck, which I think is incredibly informative and very well done. So Ed's done most of the work on this, full disclosure, but we are making a lot of really good progress on the evaluation. So with that, I'm going to hand it over to Ed to kind of take us through his deck. And I think Kate's got it already queued up for us.
Good morning, everyone.
Morning.
Thank you. Okay, so as we all know, asset allocation is one of the most important activities for any investment process. It decides about 90% of the performance. And what you see on this screen is your current asset allocation. So just to remind that 12 asset classes grouped in 3 buckets: private equity, private assets, alternatives, and public equity and public fixed income. So the process of shaping the asset allocation goes through 2 stages. In the first step, we formulate the capital market assumptions, which is really the projection of the returns, the risks, and the correlation between the asset classes for the next 10 years. In the second step of the process, we run these assumptions through an optimizer, which is a statistical technique. It's a program, ultimately, that given the set of assumptions for asset classes picks a portfolio that would deliver you the highest return at the lowest level of risk, as we call it, the efficient frontier. And of course, the goal of asset allocation is to provide for the bogey for the 7% return. Hopefully gets a little bit more with the lowest volatility. So why do we do it now? There are actually 2 reasons for urgency and timing. First of all, it's the markets. And clearly we're still going through a very extraordinary period of time with inflation, COVID, the war in Europe, disruptions everywhere. And talking to consultants of the various systems, I think the sense is either all pension systems or the majority of the systems nationally go through this exercise currently. So chances are we've been doing it probably anyway, just because of the markets. But also we have, as everybody knows, a special condition, the basket clause, right? Which is, everybody knows, was just relaxed from 25 to 35%. Can we have the next page, please? And it's, I think it's, fortunately, we have an older version of presentation. No, it was a division between, let me just talk you through it. We can, update, the slides later. But the basket clause, restricts us on several asset classes. So yeah, that's the slide. Yes.
Next slide.
Excellent. Yes. Okay, perfect. So it's, on convene. So on this page, those that can see it and those that can't, I'll just walk you through it, verbally. The asset allocation of the system is mapped onto the conditions of the basket clause. And the three categories. So anything domestic in public markets, domestic equities, domestic fixed income is exempt from basket clause. We can have as much as we want. The foreign equities combined, basket clause is everything over 10%, which means for your portfolio, the developed world ex-US and the emerging markets taken together can go up to 10%. Anything over counted towards the basket clause, and currently utilizes 4% of foreign equity. On the fixed income side, high yield is exempt up to 10%. Obviously, we're very far from this level. The current allocation is 3.6%. And in the alternatives world, the majority of alternatives count towards the basket clause, with the exemption of real assets, where you get the 10% relief. And real assets are defined as infrastructure and real estate. So currently, real assets have no utilization in basket clause. So as it stands at the end of April, the basket clause utilization for your system was at 22.2%. So we're below the limit, and obviously currently we go to 35%, which gives a lot of room to improve asset allocation. So with this in mind, let's just dive into capital market assumptions. Can we go to the next page? And
Sorry, I think actually, Elaine, it'd be prudent to stay somewhat under the limit because there's a process of repair. Once we get above that, it's a little challenging. But you're absolutely right. There's more room than you'd think. And I think probably a prudent buffer is 2%, even with that for a little buffer.
One,
Can folks on the Zoom hear us?
Yes.
Okay, thank you. And just asking for folks, some people are saying, texting me saying they can only hear inconsistently, so try to make sure to talk right to the mic.
I had a question. You said a 2% cushion. How does like what happened when our public markets go down in value, and our private markets hold up relative to that in value? How does that sort of affect the basket clause?
Well, some of the public markets are actually using some of the basket clause. So ex-US developed market equities and emerging markets. So there's an issue where as you have equity prices move down, it actually reduces the exposure for the utilization of the basket clause. Same thing with high yield, which is really kind of irrelevant for your portfolio right now because it's not above, say, 10% threshold. But it will have an impact on the utilization.
I mean, this report says 4% from the public equity. Is that's 4%, and that's so it's 14%. We get 4% on the international and the equity. Is that
that's
way
the
that
current
works? Yeah.
utilization. Yes, 4%.
Okay. And I just had one other question related to public equity. Assuming the number has gone up, to what extent do you think? I guess the question is there a domestic bias relative to the ACWI in our portfolio, and would that be something to think about when using the expansion of the basket?
Yes, there is currently domestic bias, exactly because of the basket clause. You're absolutely right. It's a little difficult to say upfront how it will shake out, but it is conceivable that developed ex-US will go slightly higher. As we go through this presentation, we'll see the Sharpe ratio and the relative Sharpe ratio, give us some idea of how optimized you may decide to allocate. But yes, it's not impossible for the domestic equity allocation to come down.
Thank you both.
Actually, if I'm reading through the lines, you're also asking probably the question about American exceptionalism and the outperformance of the US equity markets relative to non-US peers over the last decade. So we're all proud Americans, but I do think it may make sense to think about, potentially depending upon the outcome of the optimization, increased allocations to non-US stocks.
Yeah, I was kind of curious our relative distribution to the ACWI. And what it sounds like we are over allocated to US domestic relative to the ACWI. Yeah.
Correct.
Thank you.
Okay, so moving on to the rest of discussion. So the rest of the presentation will have three sections. So first, we'll take a look at the previous set of market assumptions that were formulated 2018 and implemented by the end of Q1 2019. We'll see how these assumptions stacked up against the realized performance over the last 4 years. In the second section, we'll see how the previous assumptions compare to the current vintage. And finally, in the third section, is probably more interesting. We'll look at the dispersion in assumptions across the systems and how your consultant stacks up against the others. So with this in mind, can we have next page, please? Thank you. So this page will look at the performance of the assumptions against the realized outcome for the public markets. And the way to see this chart, the gray bars represent the assumptions. It's the average across 5 systems as were formulated in 2018. The light orange bar represents the index performance during this time. And obviously, the assumptions are formulated for the public indices, not for managers. So they're kind of apples to apples. And finally, the deep orange bar represents the actual performance of your managers. And that's the actual performance earned by the system. So starting with chart number 1, which is public equities. First thing that jumps at me is that the assumptions were overly conservative. Or to flip it the other way, the performance of US domestic market was extraordinarily high. And clearly this period of time coincided with a major expansion of liquidity, be it from the central bank or from the banking system. I'm not making projections for the future, but to put this number in perspective, the long-term performance of US market stands about 7.5%. So clearly it was an extraordinary period of time. You obviously see that the domestic market performs so much better than international peers. Probably emerging markets performed more in line with the assumptions, except that it's a positive, the returns, which you see at the bottom of chart number 2, the volatility of returns was lower. And on the fixed income side, so clearly the last couple of years were very extraordinary for fixed income. You see a reflection of that in the US core, chart number 2. Clearly delivered the disappointing negative performance with the volatility much higher than the assumption. One thing that jumps at me at chart number 2 on the fixed income is high yield. And that's the theme I'll be coming back over and over during this presentation. It's the predictable nature of high yield. Across all these asset classes, the only one that lined up reasonably well against the expectations, both on the return and the risk side, was high yield. Actually, risks came out lower. And finally, the last piece to reflect on this page are the managers. And you can see across every asset class, your managers delivered an outstanding performance. US large cap is primarily indexed to the market. You don't expect any excess performance, but across every single asset class, you see outperformance of all the public indices. The asset class that jumps off the page for me is US core. So in this challenging environment, you managed to deliver the 1% outperformance. It's truly extraordinary. High yield, again, material outperformance with the volatility.
Can I just make a comment, Ed, if that's okay? This is Doug Mosley from NEPC. Can you guys hear me? Yeah, I just, obviously, I think this exercise is interesting and it's a good lens in as we begin this process. But I just would point out that none of the consultants that work for New York City, when they come up with their assumptions, which they generally update quarterly, they all have a 10-year time horizon on putting those assumptions out there as a way to inform the asset allocation process that their clients are doing. So none of them have or believe that they can predict over a 1, 2, or 3-year period what the market will result. And so I just wanted to make sure from the standpoint of everyone in the room that they understand there's a time horizon associated with the assumptions, and it's generally a 10-year time horizon, or at the very least a 5 to 7 year market cycle. And our market cycles have lasted longer than 5 to 7 years in the recent history. Thanks.
Thanks, Doug. That's all fair, and that's correct. We should have said that up front, but the return assumptions and the volatility and the correlations from all the consultants are typically 10 years. We try to have an apples to apples comparison, but that's a very good point, Doug.
Okay, so moving on, can we get the next page, please? Take a look at the alternatives, the same an exercise. You can see that the returns on alternatives lined up similar to public markets. The returns were far ahead on the equity side, far ahead of the assumptions, again, consistent with the public markets. Just one word of caution, some keep in mind as I go over the alternatives, it's the volatility assumptions. So clearly volatility in the private markets is not a relevant measure of risk, not the way we use it in the public markets. I hope everybody is familiar with this question. And the typical approach when formulating the assumptions, the volatility for private assets usually brought slightly higher to reflect the high nature, high risk level of these assets. That's why you will see a strong discrepancy between the assumed and the realized outcome. So it's only to be expected. Other than that, again, the only thing that jumps at me here on this page is core real estate. So you can see truly extraordinary performance during the last 4 years, in excess of non-core real estate, which is probably a deviation from the historical norms. Okay, so if there are no questions for the benefit of time, let's move to the next section. Okay, next page, please. And that's where we compare the assumptions formulated 2018, implemented 2019 against the current vintage. Again, we're looking at this point at the average across 5 systems. We'll look at the dispersion later. And the first thing that jumps at me, it's really about evolution, not revolution. There are no big shifts here. If you look on the equity side, there's small changes on the margin, especially for US large cap, as I mentioned, the assumptions run below the long-term performance of US equities, which stands about 7.5%. For developed world ex-US, the historical performance is about 5.96%, so the assumption is a little bit higher. Beyond that, it's really nothing extraordinary here. On the fixed income side, really what jumps at me is US Treasuries. Chart number 2, you can see that, again, a reflection of extraordinary period. The yield was repriced to a higher level, and the risks moved materially higher. So you can see at the bottom, chart number 4 for US Treasuries, what used to be 3.3% volatility, now we assume 7.3%. So for obvious reasons, it's a reflection of these and the current markets. And again, the chart that jumps of the chart for me is high yield. The risk assumptions were slightly lower, but the returns stay high and brought slightly higher. And looking at the alternatives, the next page, please. Again, it's more about evolution. Small changes on the margin. Probably the only thing that notable here is core real estate. The assumptions came slightly down, which is consistent with what I mentioned before, that core real estate delivered an outstanding performance previously. There are no big takeaways from this page. Everything's consistent. So now for a more interesting views. The next page, please. So that's where we look across 5 systems at the dispersion between the consultants. So we start with the fundamental building blocks, and even though assumptions are formulated for all asset classes, but what really matters is the assumption about the inflation, which in the current environment probably the most important assumption, and about cash and the path of cash, how the cash yields will come down. So you can see that inflation assumptions are very uniform. So all 5 systems project that within a 10-year horizon, inflation is coming down very close to the central bank target of 2%. And it's actually not surprising because the inputs for these assumptions are fairly similar across all consultants. They use the dot plot published by the Federal Reserve and the forward curve. You can see that your consultant NAPC is really in the middle, but it's all very similar.
Just a quick comment on the purpose of this slide. This is really informational only. The idea here is not to ask any of the consultants to change their views. No one has a crystal ball. It's really just to understand the dispersion and have a discussion around why and what paths they think that would get to these different outcomes. So again, this is informational in nature. We also think it's a great way to leverage the full strength of the New York City retirement systems, that we've got the benefit of 5 different general consultants that are looking at kind of similar issues at the same time. So again, the idea isn't to have any PC or anyone else change their views.
Yeah, so the next building block is cash. And cash actually fundamental to every single asset class. You see chart number 2, and that's where, somewhat surprising, you see a fairly high dispersion. Why this is so? It's really about the path towards low inflation. So depending on the assumption, of course, nobody knows the path. If you assume that inflation stays high for longer, comes down by the end of the period, you end up with a higher cash return. That's you see it for Wilshire and NAPC, the returns are high. If you assume that inflation comes down faster, you'll be more in a Callan world where they see the cash returns 2.8%. We say it's fundamental because it still determines the projected returns for all other asset classes. It also determines the Sharpe ratio, which is important for the optimizer. We'll talk about it. And finally, US Treasuries, which is really about evolution of cash returns over the next 10 years. Probably more similar. It's a reflection of the forward yield curve. Maybe NAPC slightly on the high end of the range, but we are not talking about any material dispersion between the systems. So let's dive into equities on the next page. So the way these slides are organized, you will see the return assumptions at the top in blue color, and the risk or volatility assumptions at the bottom in the green color. Starting with US equities, US large cap. And this is the single most important asset class for your system. So you have currently a 27% allocation to the US large cap. Surprisingly, we see a fairly broad range of assumptions, right? So there's a fairly material dispersion. The same applies to developed world ex-US. One point I'd like to kind of point out for you in particular for NAPC, where it becomes an outlier, you see that the return assumptions for the developed world tends to be lower. The emerging markets tends to be slightly higher. So the optimizer will probably favor emerging markets slightly more, which is partly offset by the risk assumptions. So obviously the risk and returns scale appropriately.
If you don't mind, Scott, would you mind, or Doug, was one of the questions I had in US equities. You guys are at 5.4. In developed world ex-US 5.6. Just curious as to why it's so different than the others.
Yeah. Can you?
Yeah, I can tackle that if that's okay, Scott. So, Ed's done a great job of explaining the idea and the concepts of the building blocks of inflation and cash rates and ultimately treasury rates. the assumption, if you're thinking about a 10-year time horizon with your, you know, with the assumptions you're producing for clients to use, you think about a glide path for inflation, right? And he made some good comments about Callan versus, you know, maybe the pack, assuming that inflation kind of glides back down lower, maybe more quickly, and that, you know, as a result, cash rates and treasury rates are lower. If we assume that inflation stays a little bit more entrenched over that 10-year time horizon, we also have to look at the glide path, not only for cash and treasury rates, but also for earnings and earnings growth, and the fact that the equity market is, you know, driven by pricing, which really is driven by earnings growth and valuation. So when we think about the earnings, the path for the equity market, we think that it'll glide a little bit lower, I think, than our peers in terms of the multiple, the PE multiple that we would project. And that, you know, that part of that has a relationship and ties to that view of inflation and rates. So we've had a 35 or 40-year period where rates have generally been coming down, right? And when you think about that, that has implications for corporate earnings, but also investor behavior that can drive valuation. And investors with those lower rates, in particular over the last 15 years, have gotten very comfortable with paying higher valuations for equities. And I think maybe some of our peers, you know, on the margin difference between us, they believe those higher multiples are here to stay, right? And we're saying we think rates are probably going to be a little higher, inflation's a little higher, and that means the equity market multiple should be a little lower. And you know what I mean by that is there's a direct relationship, or maybe it's inverse relationship between rates and equity valuations, right? As those rates were coming down over the last 30 years, equity valuations were trending up, and investors got very comfortable when, you know, they could borrow at 1% or 2% or under 1% of buying things that are equity like. And I say things, not just the public equity market, but real estate, private equity. And so when we look at the valuation component, we take a little bit more of a haircut on the public equities than our peers do. You know, you could call it conservative. I think this exercise informs that process. We've had some great discussions with BAM about the differences. You know, the last time we did a formal asset allocation study, we did something similar with BAM, where we went through and looked at the averages. And we were willing, I think at the time, and are willing this time, to put together our analysis using our assumptions, just like we always would. And then we can run the numbers with the averages from the 5 consulting firms, or at least have candid discussions with this board about the differences and whether an optimizer is going to tell us to do something different because of our assumptions vis-a-vis, you know, what the other boards might do with slightly different assumptions for equities. So I was a little bit long-winded, but you know, I think, you know, the public equity market and then probably our real estate assumptions are the ones that stick out. I think the rest of our assumptions are pretty consistent with the others. I obviously don't have a full insight or visibility into all the methodologies that the other firms use. We've had a lot of detailed discussions with BAM about our methodology. And of course, you know, we presented all that detail to you at that April 3rd meeting, and I can always reference back and give you the exact kind of components of our return and how we get there. We have a great asset allocation team that documents kind of all the assumptions and the data that we use to put our assumptions together. And I think for me, you know, having done this for a long time, the most important part of this is the asset class assumptions relative to each other, right? And that includes return and risk and correlation, which we'll get into some more of those assumptions in a second when Ed goes through it. But those assumptions relative to each other are what drive kind of the outcome of the optimizer, that and the constraints that we put on the optimizer. And so when we present the optimizer results to you later this year, we'll go through and talk about the implication of NEPC being more conservative with our equity assumption or our real estate assumption, and whether if we adjust that assumption, what would it change a recommendation or not? Thanks.
And just a couple things to add to Doug's reply. So we went over the assumptions with all 5 systems, all 5 consultants. And the capital market assumption, it's art, it's not science. Nobody knows the future. It's unpredictable, it cannot be projected. I would say, like having spoken to all 5 consultants, they all make sense. There's some overlap between methodologies, but there's some unique features to every system, right? Not to say they're better or worse, they're just different. And ultimately, exactly like to second what Doug just said, it's hard to judge the impact on asset allocation looking just at the returns, but just at the risks. Because there are really 3 components: risks, returns, and correlations. And what's important is the relative distribution within each set of assumptions, right? So what's more important, not compare the return of NEPC versus Wilshire, but the returns, the risks, and correlation, NEPC to NEPC, right? So the end result will not necessarily be as different as this chart number 1 seems to imply.
Thank you.
Okay, just for the benefit of time, sorry, right behind. If we go to the next page, we'll look at the same for fixed income. So starting with chart number 1, the tips. Probably most surprising to me personally, outcomes, how uniform the assumptions are. It's surprising to me given the uncertainty about inflation. US core fixed income again, fairly uniform. There's very little dispersion. High yield, surprisingly more of uncertainty, and that's surprising because I keep saying how predictable this asset class is. You can obviously see that the return assumptions are higher. These also obviously higher, and NEPC is somewhere in the middle. So again, no huge takeaway from fixed income. And moving to the alternatives, you have the next page. Private equity, probably the least amount of dispersion on the return assumption. Again, below the experienced returns, it's the volatility where we see most of disagreement. And again, volatility, as I mentioned before, it's not the volatility we observe, it's rather volatility that's modeled to properly reflect the risk profile of this asset class. So that's why you can see a fairly broad range of assumption from the low of 21.4 to the high of 29. It's probably the widest range we see anywhere in this presentation. And NEPC is exactly in the middle.
Yeah, and quick comment on private equity is, you know, obviously when we're hiring a private equity manager, we're not hoping they're going to deliver a 9% return. We use the private equity assumption, and we think of it as not including any manager value added. So the way that we think about it is, in this context, is a public equity return that you could earn very easily and cheaply and efficiently, plus the illiquidity premium of tying up your money in private equity. And that's, you know, roughly 4% or so, depending on the time horizon and, you know, any tweaks to our methodology. And so, you know, that illiquidity premium is easily kind of conceptually understood if you think about the fact that your private equity managers are typically buying companies at, you know, 5, 6, 8, maybe 10 times earnings, whereas the public equity market trades at, you know, 17 to 20 times earnings. So that difference means you're paying, you're expecting that you can buy a private company at a lower multiple because you're locking up your capital, and that's that illiquidity premium. So we obviously know that we expect some alpha on top of that.
I appreciate that, though. And it's also interesting too, if you look at the average return assumption for private equity relative to public equity, it's exactly 300 basis points, which oftentimes we think about as the illiquidity premium. It's also interesting too, Doug, you made a great point about you're assuming no value add from the asset manager. And this is where we have, unfortunately, an apples to oranges comparison. So Rokutan, for example, they assume that we're able to pick the top 40% of the managers out there. That's why they're a little higher in private equity relative to the others. But good points.
So just for me to understand this in layman's terms, Doug believes, and I'm not putting words in your mouth, Doug, you can correct me if I'm wrong, that based on the current market, there's less of a need to take as much risk due because of the higher interest rates. Is that correct?
I don't know that the assumptions get you to that statement, Liam. So I think that you're correct in that because our assumptions have gone up significantly in the last 2 years with rates, because they have a lot of interdependencies, that now the efficient frontier, which is the concept that we kind of analyze using the optimizer, is more positively sloped. So the more risk you take, the more return you get. But conversely, if you wanted to reduce portfolio risk, you could still earn a 7% based on these new assumptions, these updated assumptions, or more accurately, based on the fact that interest rates have moved back up, and we've gone through some correction in the market, maybe not the full correction. And now you could take risk off the table and get the same expected return. And that'll be what we analyze or look at, examine with the optimizer.
I appreciate it.
I just want to remind folks, we're going to adopt an asset allocation in this time period, but the belief is this asset allocation will take us on for several years from now. So when we get down to brass tacks and actually start making decisions, we have to look not just to the environment today, but what we believe the environment's going to be. And I think that Doug alluded to that in the beginning, and sort of the team at BAM, that these are 10-year assumptions for a reason, because we're building a portfolio that theoretically we should look at every year and tweak as necessary, but we're really adopting this for the long term, and presumably we'll have a similar allocation at 10 years from now, barring changes in the basket clause and other things, as we do today, but we will slightly change it from here to there. And if things really do get different, we'll have to redo the whole asset allocation. But I don't think that's the anticipation. I think the anticipation is to adopt something that we can bring into the future based on today, but also what we think is going to happen in the future.
I think that's the right point, John. I think this is an iterative process. So, and I think, Doug, you were the one that said we don't go back and clean the slate and have a clean piece of paper. The assumption is that the portfolio is actually in pretty good shape now. You've got the additional flexibility to have a better outcome potentially with the loosening up of the basket clause, but we assume that the portfolios are in good shape. So a lot of this is just iterative in terms of the adjustments we may want to do.
All right, and as we talk about private assets, it's a good point to bring the specialist consultants into the picture. If we have the next page, please. And it's probably not a huge surprise to anyone that the return assumptions generally tend to be higher for specialists, and the risk assumptions tends to be lower. I'll just leave it at that. And we had several quite productive discussions where specialists talked to the generalists. I think everybody understood the methodology, different point of view. It's really hard to say which one is right, which one is wrong. It's more about the frames and the state of mind. Obviously, the specialists tend to think about the observed volatility, and we know what it is. Where generalists tend to think in terms of asset allocation and portfolio construction. So that kind of explains disconnect. I think good discussions was a productive way to bring everyone together. Yeah, so of course, the different ways to think about volatility and risks about private assets. Obviously, without the discipline of markets and real-time mark-to-market, The valuations are done based on fair value, based on models and based on comps. So different sponsors use somewhat different methodologies, broadly speaking, similar. So when you look at the long-term performance of private assets, you see some degree of smoothing. So over the long term, obviously, the economy is the same, it's the same market, right? So there's no magic. So over the long time, everything kind of converges. But in a shorter time frame, and shorter being like 1 to maybe 3 years, the observed volatility tend to be lower because you don't have this daily mark to market from public markets. And finally, we take a look at the second set of alternatives. Have the next page. And again, not really many takeaways from this page. Private credit, much the same as I said for high yield. It's fairly predictable. And you can see that the return assumptions are fairly uniform across all consultants. On the real estate side, we touched upon this already. NAPC is slightly on the lower end of the scale. And also I would say the spread between core and non-core is probably lower than for the rest of the consultants. But again, when we look at the Sharpe ratios, will be a better point to discuss this. And much like with the previous set, when we look at the specialists, have the next page. We see the same trend. Obviously, the return assumption slightly higher, maybe not as much as for private equity, but nevertheless, and the risk assumptions tend to be lower. I'm sure that it's not a huge surprise for anyone. So we keep mentioning Sharpe ratios and the trade-off between the risk and return and risk. You can go to the next page. Yes. Okay, the next page. Thank you. So the Sharpe ratio is probably one of the more important numbers for asset allocation. And what it is simply, it's the ratio of return over risk. So the way you think about Sharpe ratio, it's how much of excess return you can realize for a unit of volatility. And somewhat surprisingly, Sharpe ratio for all asset classes tend to be almost exactly the same. Over a long term, and long term here is like 50 to 100 years, the Sharpe ratio for almost all asset classes tend to be about 0.37, which means for every unit of volatility, every 1% of volatility, you get about 37 cents of return. So this number is a good kind of measure to keep in mind as we go across asset classes and look at the performance. Kind of gives you a historical framing of the numbers. So starting with chart number 1, US large cap. The first thing is the average is 0.19. It's obviously much lower than the historical average. And you also see a fairly high degree of dispersion across the consultant. But as we said before, what's important here for asset allocation, it's not the dispersion between the consultants, it's dispersion within the consultant. And for your consultant NAPC, you can see that the assumptions for US large cap in developed world ex-US are fairly consistent. It's the emerging markets probably slightly higher. So I would expect the optimizer for NAPC will probably favor emerging markets slightly more than for the other systems.
Sorry, I had a question. The risk-free rate, which is, I guess, the measure of excess return you're talking about in a Sharpe ratio, to what extent, I would imagine the risk-free rate has gone up. To what extent are the consultants using the same risk-free rate?
They don't. It was actually one of the first pages when we talk about cash
risk-free rate. No.
They're different. It's only to be expected. That's again going back to the path of disinflation. Like if you expect inflation to come down, your cash return will be lower. And that's exactly why if you look at chart number 4, exactly for the reason you just mentioned. If you recall a few minutes ago, I talked about tips. And what I said then that there was almost no dispersion. The returns and the risk were very similar across the consultants. But what you see now is actually a very strong dispersion. The reason for that is exactly cash. So the projected return for tips was about 4%. The cash returns were also similar. And that's why you can see that Wilshire, for example, came almost negative, like minus 0.01. That's exactly why. So cash is actually quite important in this for this exercise. And one last point to mention here, again, coming back to this one, again and again, high yield. not just that it has the highest Sharpe ratio on this chart, it's also probably the least amount of dispersion across 5 systems. Again, it's the predictable nature of this asset class that jumps off the page. And the next point is we go over the same exercise for alternatives. Can we have the next page, please? So the orange bars are the Sharpe ratio assumptions for the specialist consultants. I wish I can promise you Sharpe ratio of 1. I'm reluctant to commit to this number. But going back to the question of how this assumption will fit into the optimizer and the point Liam made earlier, what you can see for private equity, even though we saw a strong dispersion in the return and risk assumptions, when I talk about Sharpe ratio, that's what matters. It's actually a high degree of consistency. Okay, so I'll stop here.
Just for a quick second. There is a large difference between our private and our public consultant on this, and I was just curious as to, is it just a matter of their company's assumptions?
It's really a matter of the framework for volatility. Like if you believe that the observed volatility is a true measure of risk, and it is observed, it is what it is. We know it's hard to argue with that. Or we can say that it's not an appropriate measure of risk for this asset class. Because remember, the entire point of asset allocation, we use volatility as a proxy for risk. Because this exercise is trying to balance the returns versus risk, right? And finally, this one more piece we haven't talked about, but it's in the appendix, the correlations. So the correlation is actually very important. That's why you cannot simply look at the Sharpe ratio and say, let's just put everything in the high Sharpe ratio. That will probably be one of the worst advices anybody could give you. The high Sharpe ratio does not necessarily translate into the best asset class. You want to build a resilient portfolio that can sustain a broad range of market moves that will not disappoint. That's part of what we'll be looking at the next stage, where we'll look at the actual asset allocation coming out of Optimizer. We'll have further discussions with consultants, and we'll try to see how the suggested, the proposed asset allocation will perform on the broad range of consumptions. Something we'll be talking about, September, October. And so we haven't talked about correlations, but they are available in the appendix, and we'll be happy to answer questions or cover anything else.
John, if I could just make one further comment. So I apologize. I know we've gone way over time and we're trying to adhere to a busy schedule. We've got a lot of folks in the room. This is very important work, though. This is going to drive 90% of the portfolio returns over time. Liam, I see you've spent a lot of time on your deck. This is a lot of handwritten notes. So we're here as a resource. I mean, Doug and Scott have been great partners as well. So reach out to any of us in BAM or any of us at NAPC if you have any questions, because there's a lot to absorb here. There's a lot of heavy math that I suspect probably there might be 1 or 2 people in the room really understand at that level.
Yeah, not me. But I just, my main concern, and we don't have to get into it here, is just how do you come to a middle ground when, obviously our private equities and our public equities seem to be on different pages in regards to what's best for the allocation going forward. So I'm looking forward to the conversation.
Well, first of all, I have to say that it's a question we're debating internally heavily. So I wish I could give you all the answers, but the only thing I can give you at this point is that something we think about all the time and trying to find the framework. One consideration that goes into this decision is the liquidity concerns. We were looking into this. We're probably not constrained as much on the liquidity side, and simply because of the basket clause at 25%. There's not that much of a concern. I would imagine with 35 because we also use public asset absorbs part of the basket clause, but probably will not be constrained. I say probably something we'll be looking at. So liquidity, we don't talk much about it, but obviously we want to make sure that the system will stay solvent, will be able to provide for the expected outflows, be it capital calls, but most importantly for the beneficiaries, obviously. So we want to preserve a cushion. And there's also a question, private equity, it's a fairly new asset class. When I say new, obviously leveraged buyouts existed for many decades. But private equity took off really after the global financial crisis, environment of low interest rates. I cannot tell you what the environment will be for the next 10 years. Again, it's something we'll be thinking about and discussing.
And ultimately, BAM, the consultants, they're gonna make a recommendation, and at some point, we at this board are gonna coalesce around a decision weighing the faith we have in all the work that was done by all the parties, and then figure out a pathway forward. And I'm sure that we're gonna get more than one option at the end of this that gets us to where we need to be. I don't think this is ever gonna be a one size fits all. And if that were the case, they would have run a computer program and handed us an option and said, go forth and do it, right? But I think that it's gonna be a very thoughtful process. And I think at some point, that's where we're really gonna step in and kind of question the assumptions that BAM brings us, the assumptions that the consultants bring us, and the assumptions that we might have about what we think is gonna happen in the world, and come up with what we think is the suitable asset allocation going forward. But I think that we have a very big role in this as well. And I think our role really is more towards the middle to the end, but I think we have a big role to play in this as well.
Are you gonna bring your crystal ball?
Yeah, of course. You don't.
Then we're good.
Eight ball with you?
We're good.
Just one further comment. And we don't have a crystal ball at the Bureau of Asset Management. There are two issues, so that we want to talk about. One of the things is we think we get a better result. So historically, we've actually gone through, it's been the purview and responsibility of the general consultants to come up with the asset allocation. So it's been much more interactive. And as I said, NEPC has been a great partner and a great source of information and insight. But typically, we'd have the strategic asset allocation, and then portfolio construction and implementation was the purview of BAM. We actually are combining all that now, because I think you get a much better result when you think about strategic asset allocation in the context of how you build a portfolio and then how you implement that. The other thing is what's executable. How can we implement? So for example, if we were to come back with a recommendation, we want to increase, say, private equity by 5 percentage points. The question is, can you really implement that given the current team? So there are other things that we'll be talking about at the STAR project that talks about how we structure and what can we do to support these better outcomes. Jimmy?
No, just as we look at these predictions and the volatility that comes through, it seems like it's steering us in a direction towards some of the things that haven't proven historically to be as profitable as we need them to be. And so it's almost as if we're going against the data that people are compiling based on some assumptions. And so how do we do that in a fiduciary manner? So we're not just guessing against what is being predicted, but the disparities are concerning. If you really look at the data from a very superficial manner, it is sending some real conflicting messages about where you should be steering your assets going forward. And so we're going to really need to have some more in-depth conversation about what caused this assumption, and then how do we deviate from them, considering you followed the path of where they're going. They're not necessarily hitting the assets that at this point are getting the returns.
Yeah, and Jimmy, I would add to respond to you a little bit that I think the differences between NEPC and the other general consultants and Stepstone, Hamilton Lane, and Axia are more anchored in methodology, and I don't think that it's as stark as these charts kind of portray. I think, as John said, our job is to kind of help you guys evaluate the trade-offs of different paths going forward. And, we've got the important thing to remember as trustees is you've got more flexibility with your portfolio now because the basket clause has been changed. And, we are going to discuss differences as we go forward. And, we will present a recommendation or a couple different paths with our own recommendation on which path to follow. And you'll have plenty of opportunity to kind of understand some more of those differences, dig into them a little bit, and get comfortable with them.
And just two more comments I want to make very quickly. First of all, I know it may look like disturbing to see this dispersion, but we looked at a number of assumptions available publicly, such as BlackRock and other asset managers. If we bring them into this picture, it gets even more confusing, right? And that's simply because That's what makes markets. Nobody knows the future, right? It's an investment decision. And ultimately, people disagree, people trade, and that's okay. That's what makes the markets go around and the economy work. The other thing, just to second that Doug's comment, once you put it in the asset allocation, a lot of difference will disappear. It seems, remember there are three moving parts, right? The returns, the risks, and the correlations, and the multiple asset classes. We showed a small subset that obviously assumptions for emerging markets, for everything. If you look across the majority of pension systems nationally, the asset allocation is not that much different, right? We're different because of the basket clause, right? We still will be different because of the basket clause. Less different, but still. But I expect the results across 5 systems will be more uniform. Putting aside hedge funds, convertibles, it's more idiosyncratic.
Okay, so that concludes, by my estimation, the discussion on the strategic asset allocation. I will say this, the team, Ed, Steve, any of the asset class heads, any of the folks that work in asset management are always available to speak to trustees on individual basis. If you have a question about something that we're doing more broadly at a board meeting, we're happy to bring people in. We expect that this will be a process where everybody will remain engaged. And at the end of the day, we'll be bringing different portions of this to the board as we proceed towards the ultimate goal of adopting the strategic asset allocation plan going forward. So with that said, if there are no further questions on this, I would make a motion that we exit public session and enter into executive session in order to discuss specific manager issues.
Second.
Any opposed? Hearing none, the motion carries.
Great. So if Bam could just let us know when the camera is off. Or Bam.
We are now in the public session. During the executive session, the board discussed various investment matters and an update on procurement. Now we need a motion to adjourn.
A motion to adjourn.
Second.
Any
Aye.
opposed? Hearing none, motion carries. We are adjourned. Thank you all.
Bye all.